Hello, folks. How are you doing, everybody? Welcome again into my channel here, Gatos FX, with your mentor, Mr. Gatos FX here myself. Like I always do, some breakdown of the financial market analysis. I sometimes also give you education concerning fundamental analysis. And luckily enough, today I would like to talk to you something concerning trade cycle. In my classes, I normally teach about the business cycle, but today I would like to focus more on the trade cycle. For those who haven't yet subscribed into my channel, make sure you click the link below into my YouTube channel. But for those who are looking for my literature book, which is written concerning a zone-to-zone strategy covering both fundamental analysis and technical analysis, the book is already on the market. Just have contact direct with myself, and then I'll tell you how I'll deliver it. So there's a slight difference between business cycle and trade cycle. There is a similarity in one way or another, but the way we used to define them has got some distinction in between them. Like when I taught you about the business cycle, I was actually referring to the three phases of economic performance. Like in the economy, there is the expansionary phase, there is a stagnant phase, and there is a depression phase. That's how the economy is moving, and this is really, really reflected when we look at the forex charts. You see those highs and lows. Is a reflection of what's happening on the ground of the economy. So if the economy is doing good, eventually we expect that you have a good GDP, you have good output, your people will be having employment, and if you are well managing your economy, perhaps even the price will be stable. That's when you say you are in the expansionary phase. But sometimes, or over a course of time, like I literally normally say that we don't have a constant economic policy which would bring prosperity throughout or constantly. The economy is keeping on progressively raising or improving. That's at least not the way how the economy really operates. And that's why we're having those swing highs and swing lows. So that's all about the business cycle. It's all concerning these three uh, phases. But when we come to the subject of trade cycle, this is quite something different. Like in trade cycle now, we are referring to the multiplier effects of macroeconomic variables. When one economic event occurs, it tends to affect more than one other economic variable or situation in the state. So the multiplier effect, which is going to be an impact of spread over due to one or more economic aspect or event or decision, it's going to bring about a reaction in the economy. And that's why I say we can discuss the formalities of trade cycle due to the causes of trade cycle itself. Previously, I've been talking about business cycle, and I said when we talk about business cycle, we normally refer to those phases like the economy is in the expansionary phase or prosperity era, then the economy can be stagnant or the economy can be depressed. So what's causing expansionary is being answered by the trade cycle. What is causing stagnation of the economy? The answer is found through trade cycle. What is causing economic depression? The answer is also found through trade cycle. Although they are all comprising with the same economic macro variables, right? Now, this trade cycle, which bring about multiplier effect on the economy once these events occurs, we can classify them based on the nature of their occurrence. Like we have those which are occurring naturally, and those which are occurring due to the effect of another economic aspect. That means one economic situation can cause multiple effects to other economic variables. But the natural cause, it just remain there, just like a natural cause. Like in the past 2 years, since 2021, 2022, we have had corona pandemic eruption. So it forced the lockdown was there, so production and productivity slowed down in most of the countries, including US, and it spread all over the world. So that's the natural cause. But also, we're having other issues which can bring about the natural cause, like the market forces of demand and supply. The increase in aggregate demand will stimulate raising price if the supply will not match the aggregate demand increase. And this is the natural cause. You cannot affect it or you cannot prevent it. If people have income and they decide to spend, there's no law which you can ban them from spending, unless otherwise we could perhaps use economic policies to destabilize their spending. Like we may opt for contractionary policies, whether fiscal contractionary policies by the government or monetary contraction policies as implemented by the central bank. So, in fact, now the phases which we are seeing in the business cycle are the results of the reactions and the causes which happens due to trade cycle. Number two, the cause of trade cycle is, as I've said, the reaction of one economic event could perhaps associate the occurrence of the other economic aspects. Think like when you are having an increase in aggregate demand, if supply is not to match the increase in aggregate demand, we expect prices of goods and services in the economy to start to rise up. Eventually, you will be facing with a situation of an inflation which has not been caused naturally, but it's a multiple effect or the spillover effect due to the increase in aggregate demand. But you can ask yourself, like, what causes aggregate demand to increase? The various factors. Perhaps sometimes it's employment. Hiring people is good for individuals, is good for the economy, is good for the state. But there is an effect, side effect of employment. The more people are hired, that means we are going to increase their income. And once the income is increasing, what is expected to occur is an increase in aggregate demand. Now, how do the inflation will be there? If the aggregate supply will not match the increase in income, eventually inflation shall appear naturally. But it's an effect which has been caused by another factor. That's number one. And number two, you can try to think like, why do the central bank play with interest rate? Why they woke up in this day, they increase the interest rate or they lower the interest rate? Interest rate is an dependent variable, unlike inflation. Inflation is dependent with the cause. Like the cost push inflation is an independent inflation because the prices will be increasing just because the input costs have been input price has been increased from where we are importing those input raw materials. Eventually, it will cause the increase in the final product. But we have something like another kind of inflation, like expectation inflation. Just due to the human psychology, when we expect there will be scarcity of goods and services, those which are available shall start to increase their prices. So this is how one economic variable could interact with another, whatever with either the cause or the solution. Like when we are having inflation, perhaps central bank may opt for monetary contractionary policies, like will increase interest rate. Now you can see interest rate is a dependent factor whereby it has been implemented by the central bank just because we have an inflation rate being raising up. And a good case study, we can look at the United States economy I have been speaking about this so many times. Since Corona pandemic, if you take a report for the past decade, 10 years, since 2013 to 2023 last year, the course of 10 years, in the United States, inflation was never exceeded a steady rate of inflation, 2%. I'm talking about annual inflation. But in year 2021 to 2022, inflation came to the rise up to 7% since Corona pandemic eruption. So before that, for the whole decade, inflation was playing below 3%. And this is what caused the interest rate to keep on rising in the United States, reaching to about 5.5% in the last quarter of 2023, and eventually it has been maintained above 5% for the first quarter in this year, 2024. So, in fact, that's how the interactions, that is how the interaction between these variables do affect one another. So, in fact, we have components which we are looking upon to bring about the causes of the trade cycle, which eventually affect business cycle. Like the same factors: production, export, demand of domestic currency, the gross domestic product, employment, purchasing power, inflation, unemployment, and unemployment rate, interest rate, savings, borrowing, lending, and aggregate demand. So these factors, in fact, are the ones which are either occurring by nature, the natural cause, causing the business cycle, or they may be occurring due to the effect of a cause or effect of a decision taken by the authorities like the central bank or the government when they implement these macroeconomic policies. Take an example, like when we are having an inflation, uh, like the case study of the United States. With an inflation, Chairman Powell himself admitted to continue using tightening monetary policies by raising interest rate. What happens when you raise interest rate? It tends to attract savers, especially for fixed accounts. So savings will be more motivated, but it will increase the cost of borrowing. And you know the big borrowers are the big investors. So if the cost of borrowing increases, eventually they will opt to borrow less and it will affect production. Production will become low. Once production is expected to decline, what will happen to the employment? People will lose jobs. And eventually what will happen? Purchasing power will slow down and will be able to cover for the inflation. So you could see these multiple effects in one side or another. But yes, we can reach the target of lowering inflation just by raising interest rate. But there could be other side effects. When you raise interest rates, you increase the cost of borrowing, you decline the production, you will decline the export, and eventually the demand of a domestic currency will be low, and hence your currency will be less effective in the financial market. So this is an interactive macro subject matter. Like you cannot say that one cause will just have a positive impact on the results. Like I normally say, there is no any economic policies once implemented in a short run or in a long run will not cause another economic effect. And when I'm talking about economic effect, it doesn't mean negative effects. No, sometimes we are targeting positive effects, but along the road to attain the objective that the central bank has or the government has, there will be some other negative impact around or across the road. So, guys, as a trader or as a financial analyst, you really need to understand how to read these reports, how to have data, and to make a clear interpretation that will give you a good prediction of the direction of the pair, in fact, which is based on the strength of the currency. What drives market is fundamental macroeconomic variables. That's what drives the market. But technical analysis will tell you now the exchange rate X will be buying up to exchange rate Y. So the entry and exit point, we can get them through technical analysis. But macroeconomic fundamental analysis, it tells now if this pair is buying, why it is buying. If it is selling, why is selling? Because we are relying on the empirical and the statistical data released by the legal authorities, which perhaps are the central bank and the the government itself. All right, guys. You have got to learn something about the tricycle. And until next time, see you. This is Mr. Gatose Effects. Ciao.